life insurance is one of the permanent forms of insurance. In that group is also universal life, guaranteed universal life, index life, and variable life, which I'll discuss each of them on a separate video. Whole life insurance is usually the most expensive form of insurance. So you would think, if it's the most expensive, why would I buy it? The reason people buy whole life insurance is that, first off, the premium is guaranteed. So you know exactly what the premium is going to be each year. And there are even whole life policies that have a guaranteed number of years, like a 10-year whole life or a 15-year whole life or a 20-year whole life. So you know exactly what the premium is each year and exactly the number of years that you're going to have it for. Certain whole life policies are based on dividends, which will determine how many years you pay for it. The other reason people buy whole life is you build up a substantial amount of cash value. So especially if you're younger, you take it out when you're in your 20s, 30s, 40s, over a 20, 25-year period of time, depending upon what dividend rate is paid by the insurance company, the cash value could end up growing at a 3, 4, 5% rate of return inside the policy, which is a great investment return, considering that it's very hard to earn a lot of money on your money today without taking risk. So it's kind of a way to have insurance forever. It's a way to build up a lot of value that you could use potentially in the future to borrow out, to pay for education, buying a house, retirement. And it gives you a fixed premium, possibly even for a fixed number of years. But again, the most expensive form of insurance. Well, universal life insurance is another form of permanent insurance. The advantage of universal life insurance is it's usually one of the cheaper forms of permanent insurance. So the premium you're going to pay is usually on the lower end in comparison to other permanent products. The other advantage of universal life is it's flexible. So certain years you could put in more money, other years you could put in less money, but you have to make sure you're putting in at least enough money to cover the cost of the policy, which would be the cost of insurance. The negatives to universal life insurance are you don't build up generally a lot of cash value, and it's not guaranteed. So if the insurance company lowers the interest rates on what they're paying you on the policy, or if the cost of insurance, which would be like the term insurance component, is raised by the insurance company, it could end up costing you a lot more money than you initially planned to pay in the policy. Those policies usually have some guarantees. The guarantees may go for 10 years, they may go to your 80, to your 90, some of them maybe even to 95. The longer the guarantees are, assuming that the premium is competitive compared to other products, the better the product.